Well, welcome back everyone. It's Fielding Pritchard from Fielding here. And thank you to all of you that sent in questions and letters and requests and so on. We're doing our best to work through them. My apologies that it's taken so long to get more of this training material out, but we've just been absolutely rushed off of our feet at the moment. But we have got a project we're working on which is a major training exercise, actually for the World Bank. So hopefully when that comes up we'll be able to use some of that material for our regular subscribers. Okay, so one of the projects, or in fact a couple of the projects we've been looking at have been looking at organizing portfolios, one for a particularly kind of wealthy individual who's looking mainly at equity stocks, and another one for a small company that has just more kind of projects than it can deal with. So we're looking at portfolio theory from a project basis. So that's what we're doing in the office. On the basis of that, we thought that we would do a little chat for you around exam-based, around portfolio theory. So this is particularly aimed at those of you who are doing ACCA, the final level papers, ICAW and ICAS. If you are doing CFA, then you're going to have to go back to the books after this, I'm afraid, because CFA does require a bit more in-depth understanding of the mathematics, and unless it's changed, you actually have to learn the formulas as well, which is a total and utter nightmare. So thanks all for tuning in. Please, you know the deal now. Please like us on Facebook, subscribe to the channel, blah, blah, blah. And what we're looking at is portfolio theory, the history of portfolio theory, what basically it means. And this will give you more than enough information if you are sitting ACCA, ICAW, or ICAS. Again, CFAs, you guys need to go back to the books. And it's not really anything more applicable you're going to learn. It's just you're going to do a lot more maths with it, that's all. So let's move on. And thank you again. So back to our portfolio theory, moving on now to slide number 2. The story as it goes, and this is a story that was told to me when I was a student all those many years ago, is that there was a young guy, I think he was in New York, and he was looking to do a PhD. And he decided that, you know, he would do this, and he therefore decided to start and investigate the possibilities of doing certain subjects, because obviously you need a subject to study. And he decided that what would be interesting would be a theory, a thesis on how risk and return are interrelated on shares. So he decided that you own shares in a company like General Motors, those shares have a return, they have a risk, and what's the interrelationship between those two things? He went away to do some cursory research, and what he found, which astonished him, and I guess astonishes us now, is that virtually no work had ever been done on this topic. There was virtually nothing on what is the relationship between risk and return in an individual security. So therefore he began to investigate this, and the first thing that we got was portfolio theory that came from Markowitz back in the 1950s. It was kind of jumped on all over by the investment business, and what happened then, of course, was that Markowitz went on to become an academic giant, publishing papers, and it led us through to capital asset pricing model, and so on. So that's our background to this. The 1950s, back in New York. Markowitz looking at the relationship between risk and return. So before he could do any real proper work, Markowitz had to say, well, let's just define those two terms. So what does risk mean and what does return mean? Return, Markowitz said, therefore, is what you get financially from a share. So we're ignoring the fact that you get to go to the annual general meeting, you get to vote and so on. He said, you know, for a guy who owns 100 shares in General Motors and lives a couple of thousand miles away from the HQ, realistically what he gets is either capital gain, so in other words, the increase in the value of the shares as time goes by, and the second thing that this guy gets is a dividend. So we've got these two things, capital gain and dividend, and that's our return. Now that, it seems fairly logical. The value of going to the annual general meeting is probably not so much if you own 100 shares. So return is measured as that, and it's, I think, a fairly easy concept to understand. The second thing that he wanted to measure was risk. Now if you own 100 shares in General Motors, what your risk really is the risk that the company goes bankrupt. So what happens if General Motors goes bust? Now the internet is full of different ways to measure this, and for certain exam systems you'd actually have to learn these different ways of measuring what the chances of a company going bankrupt. For the purposes of what we're doing for today though, and what Markowitz said is, he said, well, okay, we're measuring the chance of a company going bankrupt, So let's just use a little bit of common sense and a little bit of practical knowledge that we have. If you take a company which is very, very unlikely to go bankrupt, which is nice and safe, what can you say about it? Well, look at a water company, right? Water companies presumably didn't exist in Markowitz's day because it was the government. But if you take a company that provides water, and when we talk about water, I mean the water that comes out of your tap, assuming that you live in Great Britain or somewhere. If you get a big promotion or you win the lottery or something, you don't think, oh great, now I'm really, really going to be able to drink more water. It just is unaffected by that. Similarly, what's going to happen is that if you lose your job, while you're certainly going to maybe downgrade your car, stop going to restaurants, cut down on the cost of your holidays, you're not going to go, right, I really can't allow myself more than a certain number of glasses of water from the tap each day. So the returns, the profits and so on, return on capital, whatever, of a water company are relatively stable, and they're very, they're not going to go anywhere. It's unlikely that the company is going to disappear because they have a monopoly in their area. So it's a nice, safe company. The inference that we can draw from that is that the returns will also be stable. So nice, safe, very low chance of bankruptcy, because if the economy crashes, people still drink water. Someone else would have to come in and build infrastructure, which they can't do. So nice, safe level of returns, presumably nice, safe level of dividends, and so on and so forth. Now compare that to the shares in something like a biotechnology company, which is trying to develop a new diabetes testing kit. If everything goes well for that company, they get the approval of the BMA or whoever they need in Britain, everything works out. What will happen to the shares is that the shares will go through the roof. The price will shoot up. If they don't discover that kit, then they won't be able to repay the loans, blah, blah, blah. And if it's the only project that they've got, the company will go bankrupt. So what we will see if we look across, small cap biotechnology companies is a very, very large movement in the returns on investment. We can also correlate that and link that and say where therefore in these biotech companies they are much, much more likely to go bankrupt. So Markowitz turned around and said, okay, therefore we will measure the risk of a security as the standard deviation of its returns. And we measure the returns, therefore, over a period of time, basically 1 year, and we take the standard deviation of those returns. The higher the standard deviation of those returns, the higher is the risk. So by doing that, Markowitz was able to say, here's a share in General Motors, it has this return and this risk. Here is a share in Texas Instruments, it has this return and this risk. And so on, and so the process goes on. So that is the starting point, that is the foundation. Markowitz, back in the 1950s, he classified return, capital gain plus dividend, he classified risk as standard deviation of returns. That's your starting point. Lots and lots of different statistics he gave in his thesis, which of course he was Dr. Markowitz, and they gave some link between the two things. A very interesting piece came out of this, so he kind of already knew the answer to this going into his second piece of work. But his second piece of work is the last point on the slide, which is, can we increase the return to risk proportion by a process of diversification? Right, in other words, therefore, can we increase return without increasing risk, or can we increase that relationship? So in other words, the rate of return is higher proportionately to the risk. And can we do that by a process of diversification? Now, diversification means that we have $1,000 worth of General Motors shares, we sell some of those shares, and we use the proceeds to buy shares in a different company, a second company. That process of diversification, that is the process of diversification. Will that process increase our return in relation to risk? That is the question that we're coming on to. So, and this is just the ugliest slide ever, but what we're doing now is that we're moving from this idea that Markowitz had at the start of a portfolio where there was one type of share in it, so I think we talked about General Motors, and now we're talking about looking at a portfolio where there are two shares. So remember we said we had General Motors shares, they cost $1,000, so they had forgive me, they had a market value of $1,000. We sold some of those shares and we bought some shares in a second company. Now we need to calculate the return and risk of a portfolio where the portfolio contains two separate holdings of shares. Right, what you need to do if you are studying for ACCA or ICAS or whatever is you do need to check and see whether these formulas, these really horrible formulas that are on my slide, are given to you on your exam sheets. Certainly historically I know that the risk of a two-asset portfolio was given to you, but I don't think return was. But it actually looks really ugly here, but you can learn it fairly simply. For those of you doing CFA, you'll have to look and see what's given to you in the exams as well, but I think you have to learn this stuff for CFA. Right, it looks really, really awful, but trust me, it's actually not. At the end of the day, all you're doing is putting numbers into a formula, so all that you need to do is you need to understand what these wretched formulas look like. And there isn't a profession in the world, and we're talking about universities here, that doesn't do everything it can to extend this image of a little bit of magic about itself. But these formulas are actually not so difficult. Right, so let's just have a look at the top. It says return on a two-asset portfolio. Right, the return on a two-asset portfolio is quite simply a weighted average of the returns of the individual elements. Remember now we have two different shares. And don't worry, we're going to do a mathematical example of both of these things coming straight after this. But all you have to keep in your head is that the return, so we're just looking at the first line now with all the Greek letters in it. The first, in fact they're in English, aren't they? But all of the first line here, so the return is, right, the bit on the left that says E and then RP in brackets simply means the return on the portfolio. So the return on the portfolio. Right, the first part then says WAE open brackets RA. Right, all it means is that RA is the return on share A. So RA is the return on share A, and WA is the proportion of the portfolio which is represented by that share. So if you've got 60% General Motors shares, then WA will be 0.6, being 60%, and RA will be the return on General Motors shares. So it's the return on our General Motors shares multiplied by the proportion of the portfolio. Right, when you're calculating the portfolio, you always use market values, okay? So that's the first thing. WBRB is the return on share B multiplied by the proportion of the portfolio, which is in the form of share B. So if we sold some General Motors shares and bought some Texas Instruments, it will be the return on Texas Instrument shares multiplied by 40%, because we said we had 60% in General Motors. The proportion of the portfolio is there. So when you look at it like that, the formula is actually very simple. It's written deliberately to be difficult for you. And as I remember, that's what's on your exam sheets. So make sure you're quite clear on what those things are. Very, very basic. Right, the second one is the risk of a two-asset portfolio. So the sigma thing, the Greek letter sigma, is equal to the standard deviation. So the risk is sigma, so it's the risk squared. So those of you who know your maths, it's the variance, and the P just means portfolio. Okay, so the risk squared of the portfolio is equal to, presumably the person who did this couldn't use the square root sign for their Excel from Excel. Right, the first part, therefore, we've got WA squared, sigma squared A there. Right, W is the proportion of the portfolio which is in the form of share A. So if it's General Motors shares, we said it was 60%, so it will be 0.6. So 60% squared multiplied by the risk of your General Motors shares squared. So again, the risk is this idea of the standard deviation of returns. So it's the standard deviation of returns of General Motors shares squared multiplied by the proportion of the portfolio in the form of General Motors shares squared. The next bit is the same, but now instead of General Motors, you are going to be using, I think we said Texas Instruments. If you remember, we said we had 60% General Motors, 40% Texas Instruments. So now it's the risk, it's the standard deviation of returns of Texas Instruments squared multiplied by proportion of portfolio in the form of Texas Instruments squared. And that's the second part. And then the final part is 2, I hope nobody needs 2 explained to them, multiplied by the proportion in General Motors, proportion in Texas Instruments, the risk of General Motors, the risk of Texas Instruments, and that final curly thing, which you can see I managed to find in the symbols below, that's the Greek letter rho. Rho is the correlation coefficient of returns between the two shares. So it measures that if General Motors shares increase by 10%, what happens to Texas Instruments shares? So we get this idea of a correlation coefficient. Okay, that thing just looks so ugly and so horrible. The worst thing you can do is be frightened of it, because in the exam, if it comes up, and it does come up fairly regularly, certainly ACCA, you stick the numbers in the formula, they drop out and you get an answer. You're not going to get many questions that allow you to do something that simple. You'll have it in the exam with you, and when you know what it means, it's actually fairly straightforward. So if you're looking at it going, oh my god, I'm never going to know this, you're wrong, because by the time you get through it, you will, and it's straightforward and fine. As long as you remember your calculator, of course. Okay, right, let's move on to the next slide then, and in the next slide we'll do a mathematical example, and I'll show you how to calculate the numbers. Take a deep breath. Right, slide number 4 starts with Mrs. X. Can't be many people called Mrs. X in this world. And she owns shares in 2 companies, which are cunningly called A and B, so we didn't put much time into thinking about the company names. Company A has 2 different things. It has pre-tax returns. Sorry, Company A and Company B both have 2 different things. They have pre-tax returns, which measured presumably over a period of 1 year, are 4% and 7%. And the risk dash standard deviation, so SD is standard deviation. A is 5% and B is 10%. So hopefully it's fairly obvious to all and everyone that Company A is less risky than Company B. The correlation of the returns, so that magical thing which is called rho, is 0.2%, and it tells us that Mrs. X's shares have a total value of exactly 100,000. Oh, and these ones are pounds, by the way, not dollars. Let's hope that doesn't change later. Mrs. X's shares have a total value of £100,000, and her shares in A are currently worth £65,000. Remember we talked about the proportion of the portfolio. So is everyone okay, therefore, that the proportion of the portfolio in the form of A is 65%? Because £65,000 worth of shares are in A. Therefore, the proportion of the portfolio in the form of B is 35%, because it's £35,000. So that's where those 2 numbers come from. Right, you've got your returns, 4 and 7, in the 2 companies A and B. You've got your standard deviations, which are 5 and 10. You've got your correlation of returns, which is 0.2, and you've got your proportions being 0.65, 65% for A, 35,000, 35% for B. So all the information you need to do a good question. So, the return on her portfolio. Looking back at the information you have on slides 3 and 4, the return on her portfolio is 4 times 65%, which was the return on Company A, times the proportion in the form of A, and 7 times 35%, which is the proportion in B. And please check my maths. I'm sure now, having told you all how easy these questions are, that you're all going to find all the mistakes in. But you can see therefore that we get 5.05%. He says, fingers crossed. Please check that for me. But 5.5%. Can you see therefore all we've done is taken a weighted average of the 2. In the exam you'll have to pick through the question a bit more to get the information, but that's all that you need. As far as the risk, now do remember that risk is measured as standard deviation. Now what they've given you in that formula is they've given you the variance, which is the standard deviation squared. We use the standard deviation squared in real life because it takes out pluses and minuses. So you use the standard deviation squared there. So the variance therefore is the proportion of the portfolio which is in the form of A, which is 65%, so 0.65, and the risk of portfolio of Company A, General Motors, whatever we said, which is 5%. Notice as well, and you just kind of need to learn this. Can you see how I've written this? It's 0.65 times 5. Can you do it that way, and then your variance will come out as a nice number that you can work with. If you do 0.65 times 0.005, then you have to start wondering about multiplying through at the end. Repeat the process for stock number B, which I think we said was Texas Instruments, so 35% times 10. And then the final section is 2, 2 is 2, proportion in the form of A and B is 35 and 65, returns, risks are 5 and 10, and your row is 20%, 0.2. So if my maths is correct, the sum of all of that lot gives you a variance of 27.36. If you take the square root of that, you will get that the standard deviation is 5.23%. Everyone okay down to there? Right, it really was that simple. You simply stick those numbers into those formulas and the numbers will drop out for you. So you get that in your portfolio. The return on the portfolio is 5.05% and the risk is 5.23%. If you compare it to A, you have increased your return by quite a bit, right? 25%, with a small increase in risk. If you take it to B, if you compare to security B, you have taken a cut of what, about 2/7, whatever 2/7 is the proportion, but you've almost halved your risk. So hopefully from that you can see in some way that you have increased your return relative to risk. Just notice one other thing. I just put in the little line there. If you can get two companies where the correlation is negative, so notice here in ours that ours had a positive correlation of 0.2. If we change that, so I've actually changed the number. So what's happening at the bottom of the slide here is that we've simply changed the correlation coefficient from plus 0.2 to minus 0.2. In mathematical terms, therefore, if you look in your figure, you'll get the variance related to security A, variance related to security B, and then the whole of the next bit, the last bit, will be minus rather than plus if your correlation coefficient is negative. If we do that, the variance drops by a third, from 27% to 18%, so your standard deviation dips down to 4.27. And that's very important, because what it's telling us, therefore, is that if we have shares which are negatively correlated, we can hugely increase this process of increasing return relating to risk. Slide number 6, therefore, is just a little catch-up slide to make sure that you are all kind of with me, all with the program, as they say. So you remember that Markovits started with this idea of risk and return, and the object, therefore, is to purchase shares, I guess, if you're just looking at an individual share, that maximizes the return in relation to the risk. Markovits then extended that and said, can we increase return in relation to risk by a process of diversification? The answer to that is yes. The simple process of diversification will not achieve that, though. You have to buy shares and compare them, and that's what we did there. So we looked at what happens if we bring our General Motors and our Texas Instruments shares together, and we see, I hope it's reasonably obvious, that you can increase return in relation to risk by doing that with a correlation coefficient of 0.2. Now, what's really, really smart, however, is if you can pick shares where you have a negative correlation. So pick individual companies whose returns are negatively correlated. If you look in the textbooks, the example that they always give is buy two companies, one manufactures ice cream and the other manufactures umbrellas. Then if it's bad weather, your umbrellas do well. If it's good weather, your ice cream does. Now, companies do this in real life. So to give you a real life example, the best one I ever saw was British American Tobacco. British American Tobacco, as the name suggests, manufacture lots of lovely cigarettes, so Kent cigarettes and so on. So their main business is the manufacture of cigarettes. In terms of wanting to diversify, therefore, they knew their portfolio theory, so what did they do? They went out and they bought farmers insurance. Those of you who know who live in America will know farmers insurance advertised on the TV all the time. Right, in terms of negative correlation, there is a very, very strong negative correlation between life assurance, which is basically a bet on how long you're going to live, and smoking, which some may consider to be bad for your health. Right, that is very, very strong negative correlation. That's one company doing it itself. Now, what actually happened was British American Tobacco, for whatever reason, rather sadly made the business decision a few years ago, and it's about 7 or 8 years ago now, to sell off farmers insurance, which kind of ruined my example. But that's a bit of a shame. Okay, conclusions. Can we increase return proportionate to risk? Yes, as long as we buy the right company and we do it smartly, and we should look for negative correlation. Just one other thing to say as well is that the other thing, and this I'll probably repeat this later because it comes out later on as well, but that Markowitz also qualified that. He said that companies should stick to their core business, which is what BAT did ultimately with their cigarettes, and shareholders should negatively correlate themselves. So this process of diversification is best done by shareholders and not done by individual companies. So back in the 90s, where there were many conglomerates around the world, where we had BTR and so on, British Traction and all of these companies, Markowitz is saying that he doesn't really consider that to be correct. What the correct way to go is for a company to manufacture its goods, so to make its cigarettes, and then to allow the shareholders in the cigarette company to buy shares in the life insurance company, and shareholders themselves can best diversify. Companies should stick to what they know. What we are moving on to next, therefore, is the natural extension of that. So the extension of portfolio theory is that Markowitz said, okay, we have a share, it has a return and risk. If we diversify into 2 holdings of shares, we can increase return in relation to risk. Can we continue that process by a continued process of diversification? And that's what we're coming on to next. And I'm guessing those of you who are old enough to remember Ellery Queen, you probably know the answer already. The answer is yes, of course. Right, slide number 7, then we'll look at multiple asset portfolios. And there's no maths in this, you'll be pleased to know, for ACCA. Okay, multi-asset portfolios. So you now have this idea that instead of just simply having 2 assets in our portfolio, so 2 holdings of shares, now we have multiple assets. So what Markowitz did, and this is all Markowitz still, it's still the same guy going. I mean, remembering now that he's head professor at a huge university and he's got a whole team of people working for him. What he did was he took a whole bunch of his students, and as I remember it's something about 200, and he said to them, well, okay, you guys have got $1 million. I want you to take, not the Financial Times, the Wall Street Journal, because he was in New York. I want you to take the Wall Street Journal and invest your $1 million. Now the $1 million was notional, yeah. So they bought some shares in General Motors, they bought some shares in Texas Instruments, and some in Pittsburgh Steel and so on. Construct your portfolio. And what he did was they measured over a period of time that was something like a year for each of these portfolios. They measured what is the risk and the return over time. Now that's actually no small mean feat to do if you consider that there were no computers back in, this is the end of the 1950s now, about 1959 we're at now. So that's what he did. So what I've done, I have to say, I've just made these up, but I've plotted on the graph, therefore, something like 20 different spots, 3, 4, 5, 6, 7, 8, 9, 10, 12, I think there's 14 or 15 spots there. Right, each green spot that you can see on the slide therefore represents an individual portfolio. So let's assume that one of my old ACCA students has imagined that he or she has $1 million, opened up the Wall Street Journal, and has purchased for themselves notionally $1 million worth of securities. A second student has repeated the process, but they obviously will purchase different sets of shares and so on. So each one represents an individual portfolio. If they represent an individual portfolio, we will get a graph like that. Okay, all I really want you at the moment to be sure of, therefore, is that you're happy with what that graph shows you. This is the same graph as we had on slide number 7. So we've got our portfolios again. Right, the difference is, other than the grid lines look softer on my screen, the difference is that we have taken out the underperforming portfolios. So in other words, from the graph that we had on slide number 7, if you want to just flick back and look at that, you will see that these are the best ones, because these are the portfolios that offer the best combination of risk and return together. So what we've done is we have taken out taken out the underperforming portfolios. Okay, that's all we've done. We've left the best ones. Right, have a look at the graphs and you'll see that that's true, because these are the ones that offer the best combination of return and risk to portfolio holders. And so if you were an investor and you said, I've got $1 million, I'm going to hire these students. Hey students, how are your portfolios performing? We would choose from these portfolios because these offer the best return related to risk. Which one you choose will depend on your own personal risk profile. So that if you're someone who is in your 20s and you love fast cars and stuff and you really almost like risk, you'll be way across to the right, where you get the highest return but the highest risk. If you're someone like me who's very rapidly getting old, you'll be over towards the left, where probably not losing your capital is more important than making a very good level of return. So those are the best performing portfolios. So the only difference between slide 7 and slide 8 is that we've deleted out the underperforming portfolios. And slide number 9 is the same as slide number 8, except that we now have, on slide number 9, we have drawn a curve using my extremely vast talent in PowerPoint and Excel. I have tried to draw a nice smooth curve that joins all of those plots up together, all of those points together. So we get this curve shape. Right, it's not perfectly drawn, so I apologize for my lack of artistic ability. But you will get that nice curve shape. So you will see that return is rising against risk, not at a uniform rate. So we get this curve shape. Right, you do need to know that thing, because that thing is called the efficient frontier. So if you're writing about portfolio theory, it doesn't come up that often as a written question, but if you are writing about it, make sure that you get those words, efficient frontier, into your answer somewhere. Right, all it does therefore is it is the curve that shows us that, or the curve that links those best points, and it shows us our best point. Right, slide number 10. Now things are going to start to change. Right, in slide number 10, now what have we done? We've taken our efficient frontier, which was the curve. And in fact, what we're asking ourselves is, can we further increase return in relation to risk by mixing together government securities? Now, we use the words here government securities because that's a practical word. The word that Markowitz actually used was risk-free securities. So he assumed at that time that government securities, remember he was in the United States of America, so T-bills would be completely risk-free. So he said, well look, we've got these shares, we've expanded our portfolio, and I will tell you now, you don't need to know the maths of this, you just need to know the conclusion. The conclusion was that if we continue to diversify and diversify and diversify, we will continue to increase return in relation to risk. In fact, what he found is that the best possible portfolio that maximizes return in relation to risk is the market portfolio. And the market portfolio is a portfolio which is an exact copy of the market. That's very important in the 21st century because those things actually exist, and we call them index tracker funds. So index tracker funds actually mirror the market. So it's 100% Markowitz's theory. Very good investments as well. So Markowitz now says the best conceivable portfolio of shares, therefore, is the market portfolio. Can I further increase return in relation to risk if I mix the market portfolio with risk-free securities? Now just look at what he's doing. We're now taking a step back. What we're doing is we are saying that we're now back to two assets, because you've got two assets. One are risk-free securities and one is the market portfolio. So we've got this idea of these two assets. Taking your efficient frontier, what Markowitz said then is if you plot the risk-free point, so if you look on my graph, there's a red cross at the bottom left. Right, that is the risk-free point. At the risk-free point, the risk is 0, which is why it's right the way across to the left, and we would expect the return would be lower than any portfolio of shares. So it's over on the left-hand axis. So that's your risk-free point. What we do is we take our risk-free point and we draw a line from the risk-free point to the efficient frontier. And when I say we take it and we draw a straight line, we draw it so that it touches the efficient frontier at a tangent. And the point that it touches at a tangent is the point where we have the market portfolio. So that will be your best possible portfolio of shares. Can you see that to calculate the return on a portfolio, which now includes 2 assets, we can use our 2 asset portfolio formula because it's a weighted average of the 2 returns because we have 2 assets. And to calculate the risk, it will be a weighted average of the market portfolio. Right, what does that mean? Well, what is the risk of a risk-free asset? It's 0. So therefore, that part of the equation will be 0. If you think back to slide number 3, I think it was, it had that great big long formula on it. The first part is the weighted average of part A, which we'll say is the market portfolio. The second is what's the weighted average of the risk of part B. Well, the risk is 0, so it must be 0. And the third part includes the risk, which is 0, so that becomes 0 as well. Right, just think about your maths. What's happening is that we now only have one variable, which is the risk of the market portfolio. So therefore that line becomes a straight line. And that's why we draw that straight line which goes up as a tangent. Therefore the risk and return of our portfolio will be where we fall on that line. And that shows us that we can increase return related to risk. Because if you look at the bottom red arrow, you'll see that we can have a portfolio which has the same risk but higher return as the worst performing portfolio, and so on. Okay, I hope you understand that. The way to approach it to get your head around it is just to think about the maths of it. Go back to slide number 3, have a look at the big long formula which is the risk of a 2-asset portfolio, and then you'll see that the second and third parts must be 0. If the second and third parts are 0, then the risk of the portfolio will be the proportion which is in the form of the market portfolio. Nice and simple. Secondly, it must be a straight line because there's only one variable. Right, what do you need to know for the exams? You need to know that we have this thing, the efficient frontier, which gives us the best range of portfolios. We need to know that the best portfolio overall will be the market portfolio. And we need to know that combining the market portfolio with risk-free securities will allow us to further increase return in relation to risk. Right, you have to start to notice that there are some assumptions in this now for this thing to work. Markowitz was very smart. He always treated these things as a model. He has to assume that there is no tax. The reason that there is no tax, in fact what he's assuming is that there is no tax difference between government securities and ordinary shares, which of course in real life there is. But the point therefore is that it's irrelevant to you whether you have shares or whether you have government bonds. As soon as there starts to become a preference there because of tax, then you'll find that your line starts to skew. In fact, what will happen is if you increase tax, it will become a 3-dimensional graph. So we had to assume that. There must be no transaction cost because you must be able to move between shares and bonds easily. Everyone has the same information, so we can't have smart people who know more than others knowing which shares to buy and which not to shares. Perfect information and so on. And this is leading us into capital asset pricing model and the weaknesses of capital asset pricing model. But so far, nice and simple. Can I just say as well to defend Markowitz that every company, every merchant bank, every stockbroker I've ever worked in works with some form of portfolio theory. And if you go along to a broker because you happen to have a couple of $1 million to invest, the first thing that they will do is talk to you about how you want to structure your portfolio. Diversification is key. Okay, move on to the next slide. Nearly there now, and don't be frightened by the maths of this. I think we've probably covered all of the conclusions, but I'll just bore you to death with them once again. We can increase return relative to risk by diversification, long as you choose the right companies. And remember this idea of negative correlation. The best portfolio of shares to maximize return related to risk is the market portfolio. And you want to get those bonus marks in the exam, so say something practical. These things exist, lots of different companies now, index trackers. And index trackers are an excellent purchase in real life because not only do they maximize your diversification, but because they don't actually need a human being to manage them, the costs are very low as well. And finally, we can further increase our return relative to risk by including in our portfolio risk-free investments for the mathematical reasons that you just saw. The main reason why portfolio from an exam perspective is so important though is that it explains to you where capital asset pricing model comes from, because Markowitz and his team, including people like French, who was his number 2, were the same people that came up with capital asset pricing model. Now if you're an ACCA student, capital asset pricing model is going to be in your exam somewhere, and if you can understand the fundamentals, the basics, the principles and the assumptions that underlie that thing, then it's going to be so much easier to react and apply in an exam question. Okay, you know the deal. I hope that was useful for you. Hope you enjoyed it. If those of you who happen to just want to play around with some shares, it's worth knowing this stuff anyway. Because so many people who have portfolios, even of millions of shares, they just sit and go, oh, I fancy look at that one. I don't fancy look at that one. And they don't have a basic fundamental strategy underneath them which encompasses this idea of diversification. You know, we think technology stocks are going to rise, so we pile into technology stocks, and then of course the Nasdaq goes down, and bingo, you've lost so much of your money. So you know, if you want to impress your clients and wealth management clients, this is good to know as well. Thanks very much for listening. Please like us, please friend us, and please send in your questions. We get a lot of questions from a lot of people now, so keep them coming because they keep us on our toes as well. Hope you enjoyed that. Speak to you soon. Bye bye now.